Good afternoon or good morning, depending on where you may be joining us. Welcome to the Value Gap Illusion, why your $10 million business might only net you $5 million. So here's a quick question before we begin. How long have you been building your business? 3 years, 10, 20, maybe longer? This is what I want you to consider today. There's a very strong possibility that for every single one of those years, you've been measuring the wrong number. Not because you were careless, because the number everyone talks about, the enterprise value or the EBITDA multiple, was the number that perhaps your broker mentioned to you. I'm sure your CPA referenced it, time and again. And the number that you've been quietly doing math on in your head at the kitchen table, or maybe those sleepless nights that we all have from time to time as entrepreneurs. But that number is not what hits your bank account when the deal closes. And the difference between those two figures is what we're going to talk about today.
Okay, so today we're going to show you exactly what creates that gap, how significant it tends to be, and what a coordinated approach to closing it looks like. But before we get into the actual belly of this content, I do want to kind of set the stage and make a deal with you. So today we have two agendas, okay? And I'm going to be straight about both of them. Our first agenda is obviously to teach you something that is genuinely useful that you can use in your business. By the end of this webinar, you're going to understand the difference between what your business is worth and what you'll actually keep at the sale. And you'll have a 4-part framework for closing that gap and have a better understanding of that before you get into the negotiations of selling your business. Our second agenda is simply this. If we deliver on the first, we're going to ask you to schedule a complimentary call with us, John and I. This is not a pitch. It's not a sales, kind of tactic. It's going to be a working session to apply what you've learned to your specific situation. So here's the deal. If we teach you what we just promised in the time that we have together, which is very short, we'll ask you to take the next step, take action, do something in your business. And if we can't deliver on this message today, we part ways. So with that, John, you think we have a deal here?
I hope so. I think we do. Because most of the damage that we're going to talk about today is not the result of bad business or bad markets. It's the result of a process gap. And we're about to make that crystal clear for you. Before we do, first, a quick set of guardrails, just so there's no confusion moving forward. The lawyers and the bean counters want me to tell you that everything that we discuss here today is educational in nature. It is not specific financial, tax, or legal advice. We're going to use illustrative examples and hypothetical numbers. Naturally, your situation has details that are unique to you and your business, and everything we cover here should be reviewed with your personal advisory team before you act on it. And I'd like to add to that, if you do not have a personal advisory team who meets on a regular basis to discuss you and your business, you may have another issue, but more on that later.
Now that we got that out of the way, let's get into this. So here's what we've learned after sitting across from multiple business owners over our careers is that most people walk into a conversation like this with objections already in their head, running, voices talking. And so I'd rather kind of name some of them now and let them sit in the back of or instead of sitting in the back of your mind and distorting everything that we're going to talk about. Okay. So, one of the objections that we hear is that my CPA handles all of this. Now, your CPA is doing exactly what your CPA was hired to do, which is file accurate returns, minimize your current tax liabilities, and keep you in compliance. And that is valuable work.
But compliance-focused tax work, i.e. tax prep and file, for example, and pre-sale tax strategy are two very different disciplines. Just like a primary care physician and a thoracic surgeon, they're both doctors. But if you have a gaping chest wound, you're going to want the thoracic surgeon, right? Even the primary care physician would agree with that. So it's pre-sale planning that tends to have the most impact on your net proceeds. Things like entity restructuring, income character planning, tax advantage transfer mechanisms. These are the things that require a forward-looking coordination that almost all compliance engagements are simply not structured to deliver. Most business owners discover that distinction far too late to act upon it.
Yep, absolutely. So the second objection is this, and I love this one. I'm not planning to sell for a few years. I'll deal with it then. This is the most expensive objection on this list, and I mean that financially.
The strategies that tend to produce the most significant improvement in net proceeds, they require time. 2 or 3 years at a minimum, and longer is better. Pre-sale entity restructuring has a holding period requirement. Wealth transfer mechanisms need a runway to function as intended. If you wait until the exit is imminent, the window for most of these approaches has already closed.
And look, the reality is waiting doesn't pause the clock. Time doesn't stop. Life doesn't stop. It just, as you go down this process, if you're not planned for an exit, it shortens your options.
Yes. And the third objection we hear a lot is, John, I already know what my business is worth. And you probably do. That's genuinely not the problem. Enterprise value and net proceeds are two completely different numbers. Most business owners have spent years building the first one without ever seriously calculating the second. And that's what we want to change today.
And the fourth one, I already have a team. I have a CPA, I have an attorney, and I have a wealth manager. Now, we don't hear that very often that all three of them are working together, and having the team is a right instinct. But having three advisors who have never been in the same room together, it's just not a coordinated team. It is basically three separate professionals doing separate work, and the gaps between them are often where the value disappears. And so we're going to talk about a couple case studies in a little bit, but it needs to be coordinated.
Yes, coordination is key. We call that the silo effect. And in our experience, it's the most underestimated of the four forces that actually erode net proceeds.
Now, the fifth one, it's not on the slide here, but I do want to bring it up, is that I'm not sure this applies to my situation, and that is a fair objection. I would encourage you to stay with us for the next 30 or so minutes, because by the end, you'll have enough to make that judgment yourself. And if it doesn't apply to you, you haven't, I mean, you've invested some time, but eventually, if you own a business, this will be important to you. So the stakes for this are measured in the dollars that are in your pocket when you actually sell your business. But kind of like John went over compliance, we do think it's important that you know who we are, John and myself. I am Mike. And so before we got into one of the things that have come up in my career after raising 42 million for a handful of businesses, was that I watched deal after deal was these advisors who were supposed to be helping the business owners, which we kind of just talked about in the silo effect, that they weren't working together. So when a question crossed disciplines, the answer was almost always, that's not my area. Nobody actually owned that whole process and picture. And actually, to kind of put this into context, a partner of mine recently sold a company for 14 million. And he could have mitigated that to near zero with the right structure in place, but no one in his team actually provided solution or even the conversation to make that happen. So, and it's not because they weren't capable, but nobody owned that process that crossed all of the disciplines that they were working with. So that is why, we decided to become kind of more of a financial quarterback and help coordinate these things, to make sure that everything is playing, nice in the sandbox, as they say.
And for those of you who don't know, my name is John Heck. I've spent more than 35 years in financial services, helping my clients acquire, protect, and transfer wealth. I tell people all the time that I'm a terrible salesperson, but I'm a very good educator. I like to say my superpower is translating complexity into a process that business owners can actually understand, follow, and act upon. Through the years, I've watched some very capable, well-advised people leave meaningful amounts of money on the table, not because anyone did anything wrong, but because no one was responsible for the conversation that crossed all three advisory disciplines at once. And we're going to address that for you today.
Okay. So here's what I want you to understand before we get into the framework. Most business owners are playing a game with the wrong scorecard. And John touched on this at the beginning. They are measuring the enterprise value, the EBITDA multiples, what the business down the street sold for, what the broker told them at some conference that their business is worth. And those numbers matter, but it's not that number, it's not the number that determines whether you achieve financial independence.
The number that actually matters here is your net proceeds, the cash that actually reaches your personal balance sheet after taxes, deal structure, transaction costs, and the compounding effect of a fragmented advisory team.
Now, that difference between those two numbers is what we call the value gap. And for many business owners that are watching this either live or on the recording, that gap is not a rounding error. It is material. And in some cases, it represents a significant portion of what you thought you were going to be building in your business.
So, what we've built to address this is called the Exit Clarity Framework. It's a four-part process for understanding the real number, identifying where value is being eroded, and coordinating the right team of professionals to close the gap before you get to the closing table.
Okay, but before we walk through it, I do want to ask you something directly, right? If we can show you a framework that gives you an honest picture of what you'll actually net from your exit and a coordinated approach to improving that number, would you at least be willing to consider it? And that's all I'm asking. We're not asking for a commitment. We're asking for an open mind. Be a steward of your business, take control of that business, and actually direct it to the exit that you want and envision in your head. So if we can agree on that, let's kind of move on to this next portion here, and we can describe the two types of business owners, and then you can decide which one sounds more familiar to you. Now, the first one has a number in their head. It came from that broker conversation, a CPA offhand remark, YouTube video, or a multiple they heard at an industry event. And they've done kind of the math on the napkin, right? They are not actively planning anything because the exit feels just too far away. Their CPA does the taxes, their attorney, if they have one, handles contracts, their wealth manager, if they have one, manages their personal portfolio. But at the end, none of these people have been briefed on an exit plan because there typically isn't one.
And Mike, to be clear, this is not carelessness. This is the default because building the business has been the priority for all these years. The exit has felt like a future problem. The issue is by the time the exit becomes a present day concern, most of the high value options have already expired. So the second type of business owner is what I like to call the coordinated owner. He or she treats their eventual exit from the business as a financial project that starts years before the transaction. They have a coordinated advisory team that consists of a CPA, again, not one who spends the majority of their day prepping and filing taxes. Not that that's not important. It is important, but that's recording history. What you want here is a CPA who specifically or whose specialty rather is forward-thinking tax strategy for exiting business owners. You see the difference there? Your team should also have an attorney whose focus is entity structure and deal structure, negotiations, legal due diligence, contracts and agreements, compliance, regulatory considerations, risk management, those types of things. And the wealth manager you want here is a person who is going to be concerned with team coordination, financial planning, personal wealth and lifestyle planning, succession and continuity planning, as an example. All of these team members are aligned around you and the same exit timeline and the same objectives. Only then can you be sure that the pre-tax planning has been done, entity structure has been reviewed, and your team understands the difference between enterprise value and net proceeds. This way, when you get to the negotiating table, you can be confident that they're not first learning about earnouts and escrow provisions for the very first time.
Now, I hope you guys can hear the difference between those two, because the difference between those two approaches is not just strategic. It is financial, and the gap tends to widen the closer you get to that transaction without planning. So the question is not whether you need a plan, because if you own a business, you absolutely need a plan. The question is whether you are going to build one now when you still have time to act and to structure it the way you want to structure it, or later when most of your options are starting to squeeze, if not are gone. So let us show you exactly what we mean by this. So the exit clarity framework has 4 components. We're going to walk you through each one of them. And at the end of this section, we're going to stop and do a little project, a little exercise together. And so you're going to calculate your own rough value gap in real time. So stay with us. It's not going to be very long. It's just a little bit of a homework assignment, but stay with us with this.
So most business owners, they know their EBITDA, but very few have ever calculated what they'll actually net out at the end. So let's run through just a straightforward example first. Suppose your business generates $2 million in annual EBITDA and the industry multiple in your sector is 5 times earnings. You're looking at about $10 million enterprise value. That's the number that you've been building towards. Okay. Now, here's where the waterfall what the waterfall typically looks like. $10 million in enterprise value minus outstanding business debt. Let's use 2 million as an example. We're now at 8 million. Take out federal and state capital gains tax, depending on your state and how the deal is structured. That runs between 20 and 35% of the taxable gain. You're now looking at somewhere between $5.5 and $6.5 million, minus transaction costs out of that, investment banking, legal, accounting, which typically run 3 to 7% on a deal this size, and you're roughly $5 to $6 million.
And that's a pretty significant hit. And the challenge is we haven't even touched, we have not yet touched like on the deal structure provisions, right? If there's any earnouts or holdbacks or seller financing or seller equity buybacks, all of which affects how much of your proceeds you actually receive at closing versus receiving them over time. And so the business you thought would net you $10 million may net you 5. And that is not a worst case scenario. This is a typical scenario when there has been no proactive planning.
And I want to be clear about this. This is not intended to alarm you. It's intended to inform you that of the costly reality of not having a properly coordinated exit planning team in your corner. The waterfall that I just described, it represents what tends to happen without a coordinated plan. Now, I want you to understand that every one of those costly drains on your net proceeds, they're controllable, and every one of those levers are movable. It's just a matter of whether they move in your favor or not. Tax liability, for example, is a function of how the deal is structured and how much pre-sale planning has been done. Transaction costs are negotiable. Deal structure provisions can be addressed with experienced representation.
Okay, so let's jump into things that we're aware of, but we typically don't plan against them. So we've got some silent killers that erode And there are four forces that erode those net proceeds. We went over some of them. We're going to go into a couple of them in a little bit more depth here. So we call them the silent killers because most business owners do not see them coming until they are already at the table. So obviously the first one's taxes. It's one of the highest eroding factors of all of our money. And capital gains tax is obviously the most significant of them, but it is not the only one. So depending on how your business is structured and how the deal is classified, portions of your proceeds may be taxed as ordinary income, obviously at a significantly higher rate. Pre-sale planning can shift the character of that income, utilize tax advantage structures, and then legally reduce what you're potentially going to owe. But this does require time, and it cannot be executed in the final months before a sale.
Mike, this is one of the clearest examples of where a coordinated advisory team proves their worth. Your CPA, he sees the tax exposure. Your attorney, he sees the deal structure. Your wealth manager sees the after-tax proceeds. If they're not talking to each other before the deal is signed, each one is working with an incomplete picture.
Absolutely, because with that incomplete picture is the second silent killer, which is an actual deal structure. An earnout
Yes.
sounds like a bridge to a higher valuation, but in practice, it often means you receive less at closing and spend the next 1 or 2 years proving performance metrics to someone who now controls your business, right? Escrow holdbacks, seller notes, representations, and warranties, all provisions all affect the liquidity of your proceeds. But knowing what to push back on and what requires experienced deal representation and a team that has reviewed the structure well before you get it at the table. So by the time you're in the room with the buyer's attorney, right, if you don't have these things structured and properly laid out, it's too late to build that knowledge base. You either have it or you don't. And then the third killer is transaction costs. Obviously, there's fees to everything, the broker fees, investment banking fees, there's legal fees, there's valuation fees, and fees. We get nickel and dime to death with fees. And on a mid-market transaction, these can consume 5 to 10% of your enterprise value. Some of these are unavoidable. Some of them are negotiable. John mentioned this. All of them should be planned for well in advance, not discovered at closing.
And silent killer number 4 is what I mentioned earlier, the silo effect. This is the one most people underestimate, in my opinion. When your CPA, attorney, and wealth manager are not coordinated, meaning when each has a piece of your situation, but no one has the full picture, very often you end up with duplicated work or missed opportunities and sometimes conflicting directions. In other words, one or more of your teammates may inadvertently be undermining the others, which ultimately leads to undermining the success of your transaction and your net proceeds. So pre-sale planning that your CPA should be driving and your wealth manager should be implementing often does not happen because neither one of them know what the other is working on.
Now, here's the part that really stings. None of those advisors did anything wrong. Matter of fact, as we go through this, it may be more than those 3 advisors that need to be at the table, right? So the gap is not in any one of them. The gap is the space between them that may need to be filled with, say, a tax strategist or a deal attorney, like that kind of attorney. So understand that it's not just those 3 advisors. There's gaps in the system that need to be filled. And that's the challenge with having siloed advisors.
So let me try to clarify that a little bit with a case study. I have a business owner, let's call him David. And David had what looked like a well-staffed team. David has a long-term CPA, he has a trusted estate planning attorney, and a wealth manager who's been with him for years. And when he wants to sell, all 3 of them are involved in the process. The problem was that the 18 months before the sale, no one had coordinated on the entity structure. and his business was held in a structure that subjected the sales proceeds to a second layer of taxation. That's not good, right? His CPA knew the structure. His attorney had drafted the documents. His wealth manager was planning around projected after tax proceeds, but no one had flagged that simple restructuring 18 months prior to the transaction, which, by the way, is within the required holding periods for certain tax advantage approaches. That could have reduced his tax liability in a very meaningful way. By the time the sale was underway, it was too late. The structure was locked in, and so was the tax man.
Right? And this is the challenging part, the part that stings again. David did not leave money on the table because anyone did anything wrong. They all did their jobs. He left money on the table because no one was responsible for the conversation that crossed all three of the disciplines. That is the silo effect that we've been talking about. So, real quick, second scenario here, client Sarah, strong operator, once again, solid attorney who had been with her since she founded the business. But when it came time to sell, her operating agreement had provisions that created friction with the buyer. There were some transfer restrictions, some minority interest protections that complicated the deal structure, and the intellectual property that had never been formally documented or assigned.
And none of those were necessarily legal errors. They were the gaps that occur when legal structure and business exit strategy are not developed in coordination. Sarah's deal closed, but it closed 6 months later than it should have, with terms that were less favorable than they needed to be. Understand, time is leverage in a transaction like this. She lost some of her leverage to structural issues a coordinated team would have been able to address years earlier.
Okay, so here's the fun part. I want to do something right now, a little exercise to help you kind of work through some of these numbers. This is not hypothetical. It, I mean, it's a rough estimate of your own value gap. So I'm sure you've got a pen next to you. We all do. Open a note, grab a napkin, whatever works for you, because we're going to go through a quick exercise. So, John, walk them through this.
All right, I'm going to give you a few questions here, and I want you to work through the answers to these questions to arrive at a number, but work through it as we go. I'll try to go slow, give you a couple seconds in between to do the calculation. So, number one, what do you believe your business is currently worth? I want you to write that number down. And if you're not certain, just use a conservative estimate, 3 to 4 times your annual profit, for example. I'm sure most business owners will have a pretty good grasp or an estimate of that. Number two, do you have outstanding business debt? For example, a line of credit, an SBA loan, equipment financing. If the answer to that is yes, I want you to add it up and subtract that number from your enterprise value. I'll give you a second to do that. All right. Number three is I want you to estimate your tax liability on the gain. Now, if you're in a state with no income tax and a qualified structure, good for you. Use 20% as a working figure here. If you're in a higher tax state with a standard structure, use 30 to 35% and then subtract that percentage from what remains from the previous question. I'll give you a second to do that.
I wish we had like Jeopardy music.
Yes, that'd be great right about now. And number four is subtract 5% for transaction costs. Now, your transaction costs may be more, they may be less, but this is just an estimate for the purposes of this exercise. Now, once you do that and subtract that number from the number above, I want you to take a look at the number that you have there in front of you. The difference between step one and step five is that's your rough value gap. I wanted you to just let that marinate for just a second. Is that number bigger or smaller? Is it more or less than you expected?
I love that question. Do you want to pay taxes at the highest level on the largest exit of your life? And the funny thing, John, is so many business owners that I talk to resound like absolutely no.
Yes.
And then the next question is do you have a plan to mitigate those taxes? And the answer is also no, right? And so to John's point, like how is that number landing for you? Right? I mean, it's not it's not your enterprise value. It's just the size of the gap, right? Now, all of these questions can like be black and white. Just talk to your CPA about, look, if I sold my business today, what's the value worth? And kind of start working through that exercise, right? And so some of you may be looking at a 500,000. Some of you may be looking at 2 or 3 million or more in lost value because you haven't put a plan in place.
In either case, that gap has levers, as you said earlier, and your ability to manipulate those levers increases greatly when you have an experienced and coordinated team working for you. And I want to be precise about this. This exercise uses, rough round numbers and estimates. Your actual situation involves specifics to your entity structure, your state tax environment, perhaps your industry, your deal profile, etc. But the exercise is still useful because it makes the gap tangible. Most business owners have never done this math, and having done it, even roughly, tends to change the conversation a bit, doesn't it?
It absolutely does. And so, with that, let's talk about what we actually do about it or what you can do about it. So, I want to pull together what we've covered here. So, you came in today with a number in your head, hopefully. If you didn't have a number, at least you have one now. And that's the enterprise value you've been working toward. Now, we have shown you that that number actually that the number that actually matters is the net proceeds, and that the difference between those two figures is created by those four forces, right? Tax erosion, deal structure, transaction costs, and those silo effect of fragmented advisory teams.
And we've shown you that those forces are not fixed forces, they're actually movable. But moving them requires time, coordination, and a team working toward a single objective. And none of those things happen magically or by default.
Right. So here's what I want you to understand about inaction. Choosing not to engage with this today is not a neutral decision. Every month without a coordinated exit strategy or an exit plan is a month the tax planning window gets shorter. The restructuring options narrow, and the gap between what you could net and what you will net gets harder to close.
And that's not pressure, that's just an accurate description of how the timeline works. The business owners who tend to achieve the outcomes that we're describing here, the coordinated planning, the proactive tax strategy, structured exit, they all share one consistent characteristic. They started the conversation earlier than they originally felt was necessary. You can't begin talking about this too early.
Now, John, real quick, on a side note, uh, there are situations where you are forced to sell the business. What are they? The 4 Ds or the 3 Ds? What are those? Like
I'm not sure what you're.
divorce, disability,
Oh,
death.
yes.
Is there a fourth one?
Disability. I don't think so.
Okay. So we're not even talking about those D's, right? If something happens tomorrow and you need to sell the business or your family needs to sell the business, is it ready, right? But my point of that is that if you want help applying what we've covered today and everything else that we haven't covered today that meets your specific situation, that is exactly what we do. And I want to tell you about that right now. So remember the deal that I mentioned at the beginning. um, if we delivered, if you now understand the difference between enterprise value and net proceeds, and you have a framework for thinking about where that gap comes from, we are going to hold you to the end of it, right? We want to make sure that you get the information that you need. So we are inviting you, those that ran through this exercise today, or if you're watching this on YouTube or recording of it, um, if the number you are looking at is meaningful, and if you have time to do something about it, which you need to do it, book a complimentary value gap assessment with John and I.
Mike, before we get into what that looks like, we've spent an entire webinar talking about the cost of advisors working in silo. I would like for everyone to know here what we are and what we are not.
Oh, John, I appreciate you bringing it up, and that's why I work with you.
So Mike and I are not business valuation experts, and we are not certified exit planners. However, we have strategic partners who are those things, and they are excellent at what they do. What Mike and I are is the coordination layer that we've been talking about. Our role is to help you build the team that does not work in silos. That's the job that we're here to do.
And that is exactly what the value gap assessment is designed to address. It is not a session where we analyze your business and hand you a valuation. It is a working conversation where John and I get to know your situation well enough to determine which of the strategic partners is the right fit for you right now in your situation.
So, Mike, what does that conversation actually look like?
Well, John, that's a great question, because we like to have fun too, right?
Yes.
So let's get into that, right? It's about an hour, right? Before we meet, we ask you to share some basic context, your revenue, profitability, entity structure, your approximate exit timeline, and who is currently on your advisory team. On the call, we'll basically listen and ask questions. We want to understand the business. We want to understand the gaps in your current team and what phases of planning you are actually in. From there, we can tell you which of our strategic partners makes the most sense to bring in and then why. And then you leave that call with clear steps of who you should be talking to next and what that conversation should focus on. This is the output. That it's not a report, it's not a pitch, it's a clear next step with the right person in a short amount of time. We're not pushing this thing out 6 months. We want to keep these conversations moving.
So we've built a network of strategic partners that are specifically for this reason. The business valuation professionals, certified exit planners, M&A attorneys, tax specialists, etc. The problem we described today, advisors working in silos, is the problem that we exist to solve, and that value gap assessment is how that process starts.
So think of it this way. If the webinar gave you the framework, the assessment tells you who runs it for your specific situation. So here's the time. Scan the QR code, schedule your complimentary call today. It's just a chat. And if you're on the fence about whether you should book it, I would say to book it. Even if the call is a few weeks out, the preparation you do between now and that conversation will make it more useful.
And one more thing before we go, we are already scheduled for webinar number 2, and that one is titled Stop Tipping the IRS, Advanced Tax Strategies Your CPA May Not Be Telling You About. That webinar is going to go deeper on the tax component of the value gap, specifically the pre-sale planning strategies that are available to most business owners that are here, but rarely executed because no one on the advisory team is coordinating the effort. So you don't want to miss that one.
Okay, and the event will be posted up on LinkedIn, and I apologize for the technical difficulties this morning. LinkedIn Live is not the easiest platform, but it will be scheduled, so look for that. If you have any questions, you can find the information on my profile on LinkedIn or John's, or if you're watching this on a recording, the link to the next one will be in the description. But if this is useful today, I think you will want to be in the room for that one, and we've got actually 12 of them in total. Feel free to schedule time, drop us a message. If you found value in it, share this recording with a business owner that you know. But other than that, John, appreciate the time. Thank you as always, and we'll see you next time.
Yes. Thank you. Have a great day.